The battle over raising the debt ceiling has threatened to rattle markets and wreak havoc on the U.S. economy. And political leaders in Washington, he have been arguing for months over the federal debt limit and the conditions under which to raise it. Failure to come to an agreement would mean a first ever default on some of the government's obligations. The debt ceiling is essentially a cap on U.S. government borrowing right now at nearly $31.4 trillion. Since January, Treasury Secretary Janet Yellen has been using special measures to make avoid a payment default. But she's warned that the Treasury risks running out of cash for its obligations as soon as June 1st. JP Morgan CEO Jamie Dimon and other bank executives have warned of dire consequences if a deal isn't reached. JPO2 called it's a fluid situation with ongoing discussions between White House and congressional leaders.
House Speaker Kevin McCarthy said Thursday negotiators could agree on a deal in principle as soon as this weekend, but then talks broke down on Friday with Republican Representative Garrett Graves saying the White House was being unreasonable.
Reaching an agreement before June 1st would likely limit the economic damage. So still, by getting so close to the deadline, the U.S. risks a credit downgrade like in 2011. Here's everything you need to know about what this means for you. A partisan stalemate is the issue. Republicans want the deal to raise the debt limit to include spending cuts. They're pushing for other measures like adding new work requirements for Medicaid and applying existing work requirements to older individuals who receive food stamps. President Joe Biden has thus far rejected work requirements on Medicaid. Negotiations also involve a retracement of unspent COVID-19 funds and a process for accelerating permits for energy projects. A default would mean that those owed money, that the federal government won't get it, at least not on time. Those parties include holders of Treasury security, Social Security recipients, members of the military, and Medicare providers. Neglecting to pay bondholders in particular could result in credit rating companies downgrading Treasury debt. That in turn would result in higher borrowing costs for the government as well as everyday businesses and households, and would almost certainly lead to a recession. And while an outright default is unlikely, getting too close to the debt ceiling could still have consequences. In 2011, S&P Global Ratings cut the U.S. rating after a protracted debt limit debate, which hit markets and hurt consumer confidence. While an outright default that would wreak havoc on global financial markets and increase borrowing costs for businesses and consumers is unthinkable, a U.S. debt rating downgrade similar to mill boards, which we may work on a number one with properly publishing in, and a much properly follow this for U.S. risk assets and potentially expedite a recession. Mark Leskeret, founder of Mark Allen Wealth Management in New Jersey, said there's a good chance that the U.S. credit rating will be downgraded again. In addition to higher borrowing costs for the government, that would also likely trickle down to consumers, with mortgage rates potentially rising to 8.4%, according to a report from the real estate firm Zillow. Back in 2011, a similar standoff triggered an unprecedented credit downgrade of the U.S. government and a 16% drop in the S&P 500 over the span of 10 days, while a VIX volatility index climbed to 48. The stock market is watching the negotiations closely. Avoiding a default requires an agreement that can pass both houses of Congress, and there could be volatility as the deadline of the community varies really quickly. And in terms of U.S. Treasuries, which investors have flooded into as rates rose from historic lows, a potential downgrade or default could be a mixed bag. During times of stress, Treasuries often receive an influx of cash since they're considered relatively risk-free. That could happen again as the current situation plays out. It's somewhat ironic, given that Treasury payments
would be one of the obligations the U.S. would theoretically default on. Yet most experts expect Treasury holders to still get paid in any default. In fact, our downgrade scenario charts later than expected.
In the weeks after S&P's downgrading in 2011, Treasury prices actually rose, although that may not necessarily happen again this time. Julia Colanciano, owner of One Financial Design, Massachusetts, still recommends them as a place to store short-term cash. It's especially important to have a diversified portfolio of stocks and bonds, according to Contorno. She cautioned against panicking, but said it's worth checking your portfolio makeup and thinking about when you might need to take cash out of the market for short-term goals. You can take print money out of the market to buy a house, say in 6 months. Consider what the market might be like then, and keeping in mind time horizon for various financial goals will serve investors well, so their investments have more time to recover from short-term volatility. Colantuono said some investors are also turning to gold as a hedge against a potential default or downgrade. More than half of finance professionals in a recent Bloomberg survey said is what they would buy in the event of a default. Inflows into exchange-traded funds tracking gold have topped $700 million in May, according to data compiled by Bloomberg. And for investors that have a history with non-traditional asset classes like gold and crypto, it could be a good time to look at opportunities, said Mike Bailey, not the director of research at FBB Capital Partners.